Walmart's return on equity in 2013 was 22.27%. This can be calculated by dividing our net income by total equity, or we can use the DuPont identity and multiply the 3.62% profit margin by the 2.31 asset turnover, finally by the 2.66 equity multiplier. Harley-Davidson's return on equity in 2011 was 24.75%, and Apple's return on equity in 2011 was 33.83%. In 2013, Walmart generated $0.223 or 22.3 cents in profit for every dollar in shareholders' equity. And again, we get that from our return on equity ratio. Apple in 2013 generated nearly 30 cents in profit for every dollar in shareholders' equity. Which of the companies is more efficient at generating profits with its equity? That would be Apple, since it has the higher return on equity. Which company's return on equity improved every year? So we want to look and see which company had an improved ROE consistently over the 3-year period. That would be PP&L. PP&L's return on equity increased from 11.4% to 13.8%, and finally 14.5% or 14.6% in 2012. Recall, there are 3 drivers that increase a company's return on equity. That would be our profit margin, our asset turnover, and equity multiplier. Let's take a look at each of those for PP&L. We can see PP&L's profit margin increased from 11% to 12% over the 3-year period, so it increased and contributed to the change. The asset turnover also increased from 0.26 cents in sales for every dollar in assets up to 28 cents in every dollar of sales for every dollar in assets in 2013. So it also increased, which would contribute to the overall increase in return on equity. Our equity multiplier for PP&L also increased over this period of time. In 2010, they had $4 in assets for every dollar in equity. In the most recent year, they had $4.16 in assets for every dollar in equity. So they're taking on more financial leverage, which means more financial risk. That helps boost the return on equity. The company that is least efficient at generating profits with its equity, despite the improvement, is PP&L. It has the lowest return on equity. Apple's return on equity decreased in 2013. Let's identify which drivers contributed to the declining ROE and which ones partially offset the decline. Well, the profit margin decreased from 26% to 21%, and that would contribute to the falling return on equity. The asset turnover also decreased from 0.89 to 0.83, which would also contribute to a declining return on equity. Our equity multiplier, on the other hand, our financial leverage, increased slightly from $1.49 in assets for every dollar in equity to 1.68. So Apple is using less equity and more debt in the recent years. This increase would have helped to slightly offset the other factors which caused the return on equity overall to decline. Let's take a look at Harley-Davidson's return on equity over the past 3 years. Harley-Davidson's return on equity has gone from 6.6% to 24.39%. So Harley-Davidson's return on equity has increased. Let's go ahead and look at each one of the drivers. Which drivers increased, which would contribute, and which drivers decreased, which would offset the overall trend. The profit margin increased over this 3-year period from 3% to 11% and was a significant, in fact, the most significant factor in Harley-Davidson's increased return on equity. Its asset turnover also increased, but only slightly so. They were generating 52 cents in sales for every dollar in assets in 2011, and that has increased to 61 cents in sales for every dollar in assets by 2012. Finally, we see that Harley-Davidson's asset-to-equity ratio or equity multiplier decreased. They're using less financial leverage, and this overall would have tended to offset the increased or improving return on equity. In terms of operating performance, and again, our operating performance would be our profitability and asset turnover or efficiency drivers. Both of those improved, so we would have had an increase in ROA or an improvement in our operating performance. Our financial leverage or risk decreased over the same period of time. Financial leverage, as measured by our asset-to-equity ratio, decreased for Harley-Davidson, which again means less risk, but this also tended to decrease Harley-Davidson's ROE, or at least offset the improvements in operating performance. The company with the most stable operating performance is Walmart. Its return on equity has been a steady 22 or 23% for each of the past 3 years. It has, however, experienced a slight decline in return on equity over these 3 years. Which drivers contributed to the slight decline and which ones would have offset it? Let's go ahead and look at the profit margin. Walmart's profit margin has decreased slightly from 3.78 cents for every dollar in profit for every dollar in sales down to 3.62 cents in profit for every dollar in sales. So the slight decrease in our profit margin would have contributed to the declining return on equity. Asset turnover also decreased slightly, which would have contributed to the decline. Asset turnover was 2.33 in 2011 and has dropped to 2.31 in 2013. Finally, the equity multiplier has increased. Walmart's financial leverage increased ever so slightly from 2.64 to 2.66, which would have increased return on equity, everything else being constant. So it was an offsetting factor. Finally, let's look at PP&L's return on equity between 2011 and 2012. Between 2011 and 2012, PP&L's return on equity increased slightly. An increasing profit margin from 11.74 to 12.42% would have contributed slightly to the improvement in ROE. Asset turnover, on the other hand, decreased slightly from 0.3 to 0.28, and this would have offset the overall trend. Finally, financial leverage increased. Our asset-to-equity multiplier increased from 3.94 to 4.16. They're taking on more financial risk, but this higher level of financial risk tends to boost our return on equity.